On March 10th, US regulators shut down the financial partner of the innovation economy, as the Silicon Valley Bank called itself, after it suffered a swift collapse. The development sent shockwaves across the global tech and banking industries, stranding billions of dollars of deposits and roiling global markets. The Santa Clara headquartered lender, which catered to startups, venture capitalists, and tech firms, was the 16th biggest bank in the US before its collapse. SVB was also the second US bank after Silvergate Capital that collapsed last week. The crisis didn't end there. Banking regulators shut down New York based Signature Bank on March 12th, making it the third bank to close its doors in a week. Apprehensions of a contagion emerged because the SVB crisis was the second largest bank failure in the history of the US and the first such incident after the 2008 depression. Before this, Washington Mutual Bank had collapsed in September 2008. It had assets worth $307 billion and deposits of $188 billion. SVB, just before its collapse, held assets worth $209 billion and deposits of $175 billion. Meanwhile, the Signature Bank failure was the third largest in US banking history. On March 12th, Finance Ministry officials told a national daily that any broader contagion effects that may arise from SVB's failure would not reach the Indian banking system anytime soon, and they were unlikely to trigger any systemic risks. The government reportedly didn't expect any major effects to spill over to the Indian economy for a while. SVB's collapse was triggered by the impact of rising US interest rates on past government bond holdings. With its customer base concentrated among cash-rich American tech startups, SVB didn't have many avenues to make money by lending. Thus, the bank reportedly invested about $88 billion in mortgage-backed bonds in 2021. But the value of those bonds collapsed as the US Fed rapidly increased interest rates. This eroded SVB's capital base completely. At present, the Indian government and financial regulators are reportedly keeping a close watch on how the situation develops. The Macquarie Group also told Bloomberg that the significant reliance of Indian banks on local deposits would provide them a cushion, even as their global peers faced potential contagion from the Silicon Valley Bank crisis. According to Macquarie analyst Suresh Ganpati, amid all the gloom and doom in global lenders, Indian banks stood out with hardly any direct or indirect exposure to SVB. So, is the SVB crisis a Lehman moment?
It's too early to kind of draw to those kind of inferences and conclusions. My sense is basically as we see situation develop and as we start analyzing more incoming data out of it, we will probably come to some amount of analysis saying that how it can probably pan out.
And is there a possibility of contagion risk to Indian banking in particular?
So there is no likelihood of any contagion effect of SVB failure, primarily because this failure is due to asset liability mismatch, which could be resolved by the regulator there easily. Indian regulator is very active in that, and they have already a number of windows for any such cases. Now, last time when it happened because of bad assets or the subprime assets. Now, that's not the scenario here. So I do not think any possibility of any contagion.
Also, what data points should the authorities continue to monitor?
The key monitorables is basically the chain reaction, probably whether it is kind of there, how many people are affected with this, and you will have to kind of get those kind of data, whether this is kind of seeped in, system wide, or whether it is just kind of pretty shallow. So all of these things are kind of yet to be analyzed.
Analysts at Nomura have said that the US Fed may not pause its rate hike cycle despite the developments at the Silicon Valley Bank and Signature Bank. Meanwhile, government officials have reportedly said that if either higher interest rates or a possible SVB contagion hit more foreign lenders, it could lead to a flight to safety among global investors. This could affect capital flows into India and impact the rupee.
So if US Fed and European regulators, they increase rates, they enhance rates, certainly India will have to increase rates. Otherwise, capital will fly from here, because ideally the differential has to be 3.5% or 3%. The moment this differential is not there, then you start having the rates, the capital moving from here, unless we also increase rates commensurately.
On March 13th, a joint statement by the heads of the US Treasury, the US Fed, and FDIC said that the FDIC would complete its resolution of the Silicon Valley Bank and Signature Bank in a manner that fully protects all depositors. It added that no losses would be borne by the taxpayer in both cases. Meanwhile, US Fed Chair Jerome Powell's hawkish comments in his recent testimony to the US Congress have left investors expecting a 50-point increase in rates at the upcoming policy meeting. Going forward, lenders and regulators across the world will keep a tab on how things progress on both these fronts.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.